Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel. This will be part 2 of our calculations of degree of operating leverage, degree of financial leverage, and combined leverage part 2. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheets on the right-hand side. We had started last time with the degree of operating leverage for our couple scenarios that we had down here. Now we're going to be continuing on with the degree of financial leverage. So if you haven't seen the last presentation, you're going to want to take a look at that to focus in on the degree of operating leverage. And then we will be combining these with the degree of combined leverage. So to do that, let's go on over to the left. I'm going to hide some cells now so that we can focus in on the financial leverage over here. So I'm going to put my cursor on E and then scroll over to I. So we're on E to I, and then we're going to right click on the selected area and hide them. So we'll hide that. Now we have the degree of financial leverage that we'll be working with, and our information will be right side by side with it. So once again, there's a couple different ways we can do this. We're going to be working with this calculation, the degree of financial leverage, the earnings before income and taxes divided by earnings before taxes. And then you can think about it in terms of the change in net income divided by the change in earnings before interest and taxes. We'll be focusing here on the second item. It kind of depends on what type of information you have. Again, if you're internal to the company, then you'll have more ability to adjust the financial statements in the way you need them to do these types of calculations. If you're external to the company and getting this from public financial statements, then you may be more limited to what's going to be on the public financial statements in order to do so. So we're going to be putting this in the format of, once again, like in a tax type of Excel worksheet. So we want to be focusing in on the numerator and the denominator. The outer column of our worksheet will then include the numerator and the denominator, and then we'll divide those items out. So we're going to have first the earnings before interest and taxes. The earnings before interest and taxes is given here. That's often going to be the operating income of the company. So in the case of our income statement here, we've got the revenue that's going to be calculated as the sales times the unit price of sales minus, instead of the cost of goods sold, as would be the case in normal kind of financial statements, this being a contribution margin format income statement, we're going to subtract out the variable costs, and then we'll subtract out the fixed costs to get to the earnings before interest and taxes. Similar kind of calculations for a normal financial statement, where you take the sales minus the cost of goods sold, gives you the gross profits minus other operating expenses to give you basically earnings before interest and taxes, basically operating income at that point. So we'll be picking up that number. I'm going to put it into the outer column. That's going to be the $476,000. And then we have the earnings before taxes, meaning we're now going to take into consideration the interest, which is going to be part of the items related to basically the financing, right? Because if you have financing, you're going to be paying the rent on the purchasing power, that being the interest. Now here we actually have this number, earnings before interest and taxes, but I'll do a little calculation on it because depending on the format of the income statements, you may not. So for example, you might have the earnings before interest and taxes, which might be the operating income. You might have basically the operating income, which would be this. That's going to be the earnings before interest and taxes, which is the same number here, and then be pulling out basically the interest. So the interest being this number, the 56, and that's going to give us the earnings before taxes. So the only thing before we get to the bottom line number, net income, is taxes, right? Earnings before taxes. Now you might see it. You might have actually net income. If you're working from the bottom, then you'd have to take net income minus the taxes, and then that would bring you back up to basically earnings before taxes. Is another way that you might have to get to that number, earnings before interest, earnings before taxes. So then I'm going to subtract this out. This is going to be the 476 minus the 53. Going to put an underline here. We're going to go Home tab, Font Group, and underline, and that's going to give us our degree of financial leverage. And that's going to be equal then to the numerator divided by the denominator. So earnings before interest and taxes divided by earnings before just taxes. So the difference being the interest, which relates, of course, to the debt. Then we're going to go to the home tab, numbers and percent. I'm sorry, let's do that one more time. We're going to go home tab, numbers, and then add decimals. Now we can keep on adding decimals. I'm going to keep it at the 2 decimals that we will be adding here. So there we have that. Let's go ahead and do some indentations. I'm going to select these items. Home tab, alignment, increase the indenting. I'll increase the indenting here. Home tab, alignment, increase the indenting. Let's put an underline here. Home tab, font group, underline. Let's put the double underline here. Home tab, font group, and then the double underline. So like basically any of the leverage type of calculations, as it goes up, then the risk basically goes up, but the potential for gain based on the added leverage could go up. So you have a multiplier kind of effect in the case of good times. Then you could have an increased, it could multiply the good times. In case of bad times, things go down, then it could multiply the bad times. And if we go down to our calculations down below, where we had this different data set, we made a change over here which affected the operating leverage, that being that we had the income before interest and taxes being the same as the income before interest and taxes here, the 476 and the 476, but then we changed the flow between the variable costs being less and the fixed costs being more, meaning there was more operating leverage. The financial leverage would be the same. So we're going to do the same calculation for the financial leverage, even with this B scenario where we have different numbers, but there's no change to basically the earnings before interest and taxes and to the interest that's being affected. So let's just do the calculation again, but I'm going to pull over the same numbers by saying equals, and then I'm going to pull up the same names here. And then I'm going to autofill that down so I can pull them in with a formula by putting my cursor on the fill handle, dragging down. Then I'm going to format paint it so I get the same formatting. And I want to format paint the entire thing because I want the underlines and everything and the decimal points on the numbers. So I'm going to go to the Home tab, Clipboard, Format Painter, and then scroll down and I'm going to just format paint this entire thing. Then we'll add the numbers here. So it's going to be the same kind of calculation you'll see, even though we had that change over here on the income statement. We're going to say that the earnings before interest and taxes is going to be basically the operating income, this number, which hasn't changed, even though the breakout between fixed and variable costs has changed. Then we've got the earnings before interest and taxes, same number. And then we're going to be taking the interest. So the interest, which is this item, and that's going to give us the earning before taxes, which is this minus this, which we already have here at the 423 because of the multi-step statement. And that's going to give us our degree of financial leverage, which will then be equal to the numerator over the denominator. And we get that same 1.13, and the 1.13. So again, same number because the changes that took place between these two were simply with regards to the types of costs or expenses, variable and fixed, not with the operating leverage, not with the interest, which would be the major factor here. So now we want to take a look at the degree of combined leverage, which is going to be our next item. So one way you can do this is you can simply multiply them together, the two leverages out. So to do that, let's unhide some cells, and let's do that first. And then we'll do the calculation, a calculation for it as well. So what I'm going to do is I'm going to put my cursor on C column, left click, right click over to J, so CJ, and then I'm going to right click on that selected area. Don't right click on these items because it'll mess it up. So we're going to go from C to J, and I'm going to right click on the gray area somewhere, and then unhide. So we're going to unhide, and then I'm going to move all the way. So what I want to do is I want to be picking up the bottom line numbers. Here's the degree of operating leverage. Here's the degree of financial leverage. So we want to think about the degree of combined leverage. First, let's do that the simple way. Now that we've calculated the other two, we can do that over here and just multiply the two together. So I can say this will be equal to then the degree of operating leverage, that 1.97 about, because it's rounded, and the 1.13 about. And that gives us, if I move back up top, Home tab, numbers, and add the, I'm sorry, not the percent, undo the percent, the decimals, add a couple decimals, we're at the 2.21. That's one way to calculate it. We can do it down below here. I can say, okay, let's do it down here as well, where the change took place. There was no change to the financial leverage, but there was a change to the operating leverage. So if I did the same kind of calculation down here, then we're going to say this will be equal to, and we had in this section, we had the degree of operating leverage times the degree of financial leverage, and that's going to give us 3. And then I'm going to go to the home tab, numbers, increase the decimals. We're at 3.2. Okay, so now let's go ahead and calculate it. So let's calculate the combined item. To do that, I want to see my data side by side again. So I'm going to put my cursor on the L column and then drag all the way over to I. So I to L, ill. It's going to be ill. And then I don't click on these little pictures. I'm going to click on the gray area somewhere and then hide. Okay, so there we have it. And hopefully this picture will be on top. And this is where we have our combined leverage. So we have the combined leverage. You can see it in a couple different formats. We're going to be working with the one up top, the combined leverage being the contribution margin that will be calculated and divided by the earnings before taxes. The earnings before taxes, that's what we will be calculating here. You can also see it as the operating leverage times the financial leverage. That's what we did down below. And then an alternative method are these percent changes that you can use as well. So we're going to be focusing in on the item up top. We're going to be focusing in on the contribution margin. So we'll do this in, once again, this kind of tax form format. So in this outer column, we want to get to our numerator and denominator, which we can then divide out. So the numerator is going to be the contribution margin. So we're looking for the contribution margin. So we can calculate that in a similar way as we saw in the past. There's a couple ways we can do it, right? If we have this information here, the sales minus the variable costs, we could subtract them out, or we could do it in the same format as was shown before. We can take the contribution margin per unit, multiply it times the units sold. So let's just do that once again. We're going to say that we have the units sold. I'll say units sold are going to be equal to the 26,000. And then I'm going to calculate the contribution margin per unit, colon. So this is another subtotal that we're going to have. And I'm going to give us the unit price per unit, which is going to be equal to the 72. And then the unit variable cost, and that's going to be equal to the 36. I'm going to subtract those two out, put it in the outer column. This is the 72 minus the 36, which is the contribution margin per unit. And then I'm going to do some formatting here, selecting these three, go into the Home tab, alignment, increase the indenting, selecting this item, Home tab, alignment, increasing the indenting, underline this one, Home tab, font, drop down, underline this one, Home tab, font, underline. That's going to give us then the contribution margin, which is going to be equal to the units sold times the contribution margin per unit, which we could also have calculated once again as the total sales minus the total variable costs gives us the same number. Then the denominator is going to be the earnings before taxes. So and that's going to be equal to the 423,000. And that's going to give us our degree of combined leverage. And that's going to be equal to the contribution margin divided by the earnings before taxes. Let's add some decimals. Home tab, numbers group, add in a couple decimals. Let's put an underline under the 423. Home tab, font group, put the underline there. Let's put the double underline on the degree of combined leverage. Home tab, font group, drop down, double D underline. So there is our 2.21. 2.21, again, as these leverage items go up, when you're making comparisons to prior performance and or projections into the future in our own company and comparing to other companies, then the more leverage, the more, there could be earning potential to magnify the earning potential in good times. And then in bad times, you're having more risks, meaning the downturn could be worse with the increase in the leverage. Let's do the same thing down here. I'm going to do our little formatting trick with this again by saying this is going to be equal to, I'm going to scroll up, I'm going to pull up the first number and just do it with a formula. And then I'm going to autofill that down. I'm going to put my cursor on the autofill handle, drag on down. Then I want to copy the formatting. So I'm going to go back up top. I'm going to copy the formatting for the whole thing, selecting the whole thing so I get the numbers formatted as well. And then we'll just calculate it one more time. I'm going to go to the Home tab, Clipboard, and use the Format Painter. Scroll on down. I'm going to just paintbrush this entire thing. So there we have the formatting. Then we're going to be picking up the numbers. So the 26, the units, is going to be the 26 once again. The unit price is now the 72, but now the cost is 20. Subtracting those two out, the 72 minus the 20 is now 52. The contribution margin being the units times the contribution margin per unit. And we could also have gotten to that by taking this number, the sales total minus the total variable costs to get us to that same number. Then we want the earnings before taxes, and then we'll divide that out. This equals this number divided by this number, and that's going to give us the 3.2. So the combined leverage has gone up. Why? Because the operating leverage went up, even though the financial leverage did not go up. The operating leverage went up because we have more fixed costs as opposed to the variable costs. So there we have that. And now let's just take a look at our break-even analysis for one more type of calculations. I'm going to go ahead and hide these cells again from N to I, or what? Actually, that's an R after Q is R, I think. But you can't see it because it looks like an I because it's really small. But in any case, we're going to highlight from N to R, NR, and then we're going to right-click on those and hide. And then don't pay attention to this item up top because we're just doing our old break-even formula, which we totally know by heart by this time. It's going to be the fixed costs divided by the contribution margin per unit. So we'll start here with the fixed cost. Fixed cost is going to be then the 460,000. We're then going to divide that by the contribution margin per unit. So the contribution margin in units, colon, is going to be the unit price, the sales price, which we know is the 72, minus the cost, or the unit variable cost, which is going to be the 36. Subtracting those two out will give us the contribution margin in units. That's going to be then equal to the 72 minus the 36, giving us 36. And then we're going to be saying that that'll give us the break-even point in units, which is going to be equal to the 460,000 divided by the 36. Let's go ahead and put some underlines here. I'm going to say Home tab font group, underline there, underline here. Home tab font group, underline there. Double underline here, Home tab font group, double underline there. Okay, let's do the same thing and calculate the break-even point down below. Well, let's do one more formatting. I'm going to select these three items. Home tab alignment, increase the indenting, and this item, Home tab alignment, increase the indenting. So now let's go on down below, do the same kind of thing. We know that the things that have changed here are that the earnings before interest and taxes are the same, but there's a different breakout between the costs allocation between variable and fixed costs. So now let's do our break-even point here. We're going to say, all right, the fixed costs now have changed. These are the fixed costs, and they are at the 476,000. Then we have, and let's actually copy the format over here before I get too into this. Let's say this will equal, I'm going to scroll back up and pick up the fixed costs up top. Same kind of formatting thing. Enter. I'm going to then autofill that down, putting my cursor on the fill handle, dragging down. Then I'd like to format or copy the format of this entire thing. Going back up, selecting the entire thing here. Go into the Home tab, clipboard and using the format painter to then format paint this entire box. So there we have it. And then we're going to take the unit price 72, and the 20 for the unit cost. Subtract those two out. The cost is now lower than it was before. Sales price the same. So that's going to affect our contribution margin being higher, now at 52 versus prior at 36. And then we're going to divide this out. This will be the 876 divided by the 52, giving us the 16,846. So in order to break even here, we would need the 16,846 as opposed to up top where we only needed the 12,778. And that is going to be due to the fact that there's a difference in the allocation between the variable costs and the fixed costs. Kind of, you can correlate that to the degree of operating leverage. Okay, so now let's unhide all of our cells here. I'm going to put my cursor on C all the way to S. So CS, and then right click on the selected area and unhide. So now we have all of our information for the degree of operating leverage for these two scenarios. And then we have our degree of financial leverage. And then we can combine those two together to give us our degree of combined leverage. And then you can think about how the break-even point can feed into those items. And you might want to, toy with these numbers and look at some different scenarios here and just look at the variations that will happen and get a feel for the relationship between these calculations. We'll do another practice problem related to this as well.